Hello and welcome to the special edition of Market Makers. At a time when global economy is threatening to slow down, asset prices are correcting, global volatility has shot up. What is the way forward for Indian and global economy? Is this the beginning of the pain, or this is a great opportunity and now Indian markets and Indian economy has a serious case of outperforming? We'll debate that for you on this edition of Market Makers over the next 60 minutes on ET Now. I have with me two very special guests, Rashesh Shah, Chairman Edelweiss, and along with Rashesh, I have the head of India's largest retail brokerage, Mr. Dinesh Thakkar. Gentlemen, evening to you and thank you for joining us. Rashesh, you go first. What do you make of the current mayhem in global markets and what are the chances we could see a repeat of 2008?
I think currently what is happening in the world is people are grappling with, the slowing down of the economy in US and other parts, including the European crisis. And what we are seeing are unprecedented events taking place. A week ago, there was apprehension that the US will default on the debt obligation. Even now that, the US Treasury getting downgraded is still a key fear. So I think we are currently in unprecedented territory, but I don't think it is like 2008 for one simple reason. 2008, the world was very optimistic. Everybody was, overbought. Everybody was long. If you saw what happened in 2007 and all. So it came out of 5 years of gung-ho markets, a lot of optimism. People were completely overbought to the brink. What we are seeing now is for the last 1 year, I think Indian markets, overseas markets have not gone anywhere. Already volatility has been very high. So we don't see people having been so over-optimistic and so overly, into the market that they will get caught in the wrong way. So it won't be 2008, but it will still be painful because of the unprecedented events that we are seeing all around us.
So Rashesh, is this just the beginning of the pain, and do you think pain is here to stay for an extended period of time?
I think globally there is going to be some amount of pain on this. I do feel in India we have been suffering the pain for the last about 5-6 months. So it's not the start of the pain for India, because I think for last at least since October, the Indian economy and the market have been going through some pain or the other. So I think, but I think the global markets are starting to witness this now. So it will obviously have its own effect on India, but India, I think key problem still continues to be inflation and interest rates. And as long as inflation is high in India, I think the pain will continue. So I think we are still experiencing it, and our estimate is in Edelweiss, our house view is that maybe another 2 to 3 quarters until inflation comes down and interest rates come down in India, optimism in markets and economy will not come back into India for some time.
Dinesh, jump in on that one. What is your
proposal? Our house view is
just the beginning of the pain.
I believe it is an end of a consolidation phase that India entered into last 4 years. If you look at what kind of pain that we are going through, is that today also it is very difficult to predict at what rate India will grow. If you go back to the era of 2003 to 2007, India started to grow from 6% to around 10%. So all experts and analysts went wrong in trying to extrapolate at what rate India can grow. So we went into an evaluation where it has to be corrected so that we come to a level where we say that valuations are fair enough. Although economy grew in this last 4 years, and even corporate earnings grew by 30-40%, but market is where it is. That is because today we don't know at this juncture at what rate India economy can grow, whether we can continue to grow at 8% or we may slip back to around 6.5. Main problem was in India, inflation. After the global crisis, when we again got back to growth trajectory, we realized, our government and our bureaucrats realized that we have a supply chain problem. But definitely this was fueled by very high international commodity prices. Developed countries were trying to fuel their economy by stimulus package. Definitely it was right for them to fuel their economy or protect their economy by giving stimulus package. But as we can see that US someday or developed countries somewhere has to realize that they have to get back to a normal growth trajectory, and they can't continue with this kind of artificial fiscal stimulus. So now we are saying the time has come that US has decided that we will again start deciding on reducing our fiscal deficit, this is going to reduce their consumption. See, in 2007-2008, when global GDP was growing at around 4.5, we realized that it is very difficult to manage resources that we have. Inflation was really out of hand. Now it would be a good development for emerging country like India that they will start consuming low, and for India it would be opportunity to control their inflation. That's the main problem within India. If we are able to control inflation, that means we will be having a sobering impact on interest rate. And definitely, at least by December, we can say that India can grow at the rate of 8% or something around. If that's the case and valuation is where it is, I think a good phase of India is going to begin.
Rashesh, the only silver lining in this stormy environment is commodities and the way commodity prices have corrected. Growth for India could slow down, but if inflation comes down, do you think that could re-rate Indian markets and Indian economy?
Yes, I think absolutely. I think as oil prices come down, I think the confidence in the Indian economy and ability to bring down inflation will go up. I think the key apprehension that we continue to have is if there is any liquidity stimulus in the overseas market, if the US Fed decides to do something like a QE3 or an equivalent of that, then again commodities will go up because any liquidity infusion will be inflationary for commodity prices. And India will end up importing inflation. If you see even our current inflation woes we have, they started off with QE2. So any version of QE3 for India may have inflationary impact, which is not going to be good. But in the absence of QE3, I think if the global growth is slowing down, if commodity prices are cooling off, it is overall good for India.
What is the biggest risk for Indian markets, Rashesh?
I think a large part of our internal risk, if you see risk, I call them internal and external. Our internal risks are, economic slowdown, inflation, high interest rates, the issues of governance that we are having. But I do believe all that is in the price. I think it's not new. For the last 5-6 months, all this has been, grabbing the headlines. So our internal issues are in the price. There won't be any shock in this because I don't think anything is going to get, reached, exceedingly worse from what is already estimated in terms of where we are in the economic terms or the inflationary terms. I think the shock, if any, will come because of global events like what is going on right now. And as I said, in the short term, it will be aversion to risk assets because every time global volatility goes up, people shun risk assets, which are mainly emerging markets and commodities, which is what we have seen in the last couple of days. But on the long-term basis, if there is any liquidity infusion, then the inflationary impact on India is the real risk going forward because then RBI and the government will have to fight harder to fight that import of inflation that will happen to us. So I think in the short term, any global event away from risky assets, and in the medium to long term, any inflationary impact which gets imported into India.
Dinesh, what do you make of the jump in volatility? Yesterday night, the global volatility indicator, the CBOE VIX, shot up by about 30% plus, and that's rare.
I think what has happened, US announcing the reduction in fiscal deficit came as a bit shock to everyone. Nobody was expecting that it is going to happen so fast. So in that sense, I think analysts were still continuing that US will continue with their fiscal stimulus package and they would not go for soft landing so fast. So it appears that maybe when analysts are not ready, they haven't really factored in all this less consumption that US is going to do and impact on corporate earning. So definitely there would be some knee-jerk reaction. That is what we are witnessing, that they are getting adjusted in prices, and as now information very fast, and analysis are done very fast. So definitely impact on prices also come very fast. In that sense, I feel what is happening is good for overall market, that prices get corrected to a right valuation so that a proper base is formed.
All right, gentlemen, stay with us. Let's take a quick break on market makers. When we come back, Nirmal Jain, chairman of IIFL, he will also join us. Welcome back. You're watching Market Makers. Crash or correction? Is this beginning of the pain, or this is a great opportunity where investors should start hunting for some bargains? Rashesh, this question may sound rather simplistic, But at a time when cost of capital is moving up, how will things change for Edelweiss, and what will happen to the risk of NPA?
I think the cost of capital will obviously go up, but only the good news is the cost of capital has been going up for the last almost a year. If you go back and see from last year August onwards, cost of capital interest rates have been going up. I remember, I think short-term borrowing rates in April 2010 were about 5.5 to 6%, which by March 11 became close to 11%. So I think a lot of the price increase has happened, and I think since almost all capital market players also have repriced their assets, I think spreads will be constant. So as the price goes up, because usually we have seen for capital market players, if there is a gradual increase in interest rate, they are able to pass it on to their clients. If there is a sharp increase, then it's not easy for them to pass it on. So I think if there is a 40-50 basis point increase which has happened because of the recent RBI move, it will get absorbed and passed on. So I don't expect capital market players to have any contraction of spread in this year, though in the last year I think everybody experienced some contraction of spread.
Let me also introduce and welcome Nirmal Jain, Chairman of IIFL. Nirmal, what a delight to have you on ET Now. Thank you for joining us. Nirmal, how should investors approach the current market mayhem? Should they panic, or should they approach the current market mayhem with some degree of calmness, wait for the dust to settle down, and then pick up some bargains?
I think there's nothing to panic in the current market mayhem. Stock markets have a character, so they will tend to be volatile like this. And this kind of volatility we have seen in the past also, and I think this is not the last one. We'll see probably no more such things in future. But having said this, there are quite a few positive things in what has happened today in the crisis that is happening. One is that crude oil prices, they already corrected to, the Brent has come down to $105. I think it falls by another $10. That will be one of the very good news for India, because quite a few ills are related to crude oil prices. There is a fiscal deficit or current account deficit or high inflation or high interest rate. And also globally commodity prices are expected to fall. That again will help RBI to not resort to further rate hikes, and that has been one of the key problems that Indian corporates have been facing. So I think there is, whenever such an event happens, there is a panic in the market, and market reacts in a particular manner. But I think there is an opportunity also, so market might continue to react or continue to correct for some more time. But I think wait for a couple of months, and I think we will see recovery much faster than the rest of the world in Indian stock market.
Nirmal, so what is your bear case scenario, and do you see 5,000 on the Nifty holding out?
Yeah, 5,000 should hold out. In a bear case scenario, market may dip very temporarily to 4,700, 800. My personal feeling, my own assessment is, if market goes down in that manner, it will bounce back also very quickly. Because I don't think that we are in a market where a vertical fall is likely. Primary reason being that economy continues to do well. Fundamentally, we are in an economy which will probably grow, even if 8% comes down to 7%. But nobody is talking about less than that. So in a market like this, at every fall you'll find new buyers, and there are always bargain hunters. There are long-term investors who look at opportunity, and market will find support.
Dinesh, do you see 5,000 acting as a bit support for this market?
Yeah, definitely yes. There is no reason for us to believe, based on fundamentals, that market will go down below 5,000. But definitely it is very difficult to take a call whether it will stay in this range or maybe temporarily go down. So as we know that liquidity plays a major factor. If at all FIs who had bought last year to the tune of around 25-30 billion, they decide to sell some stock. Temporary movement, it can go down. But looking at valuation, definitely there is a pipeline which is there to absorb all the stocks. So based on fundamentals, definitely it does not appear that we are going to break 5,000 level. Below 5,000 level, definitely market appears to be in a very good value zone. If I take 5,000, that means we are discounting for 12 months earning by around 13.5 or something. And when we are expecting a GDP growth of around 7.7, 7.8, I do not think that market really deserves this kind of a beating. But having said this, I feel that investors should keep in mind that they should not go for bottom fishing. They should go for fundamentally good stocks. Because when a market will change its course, it will change slowly, and it will take some time. Because there are a few microeconomic headwinds that we are facing. if at all a clarity comes on when and how we are going to see this inflation and when we are going to see interest rate coming down, then definitely market will go up suddenly, and for investors it is very difficult to time the market. So I think that for investor it is good that he keeps that in mind, that 5,000 appears to be a rock bottom right now. So if he takes some position, he should keep in mind that momentarily market can go below that. But I don't see any kind of a case where actually level of below 5,000 is justified.
Rashesh, from a 6-month perspective and from a 12-month perspective, do you think equities will outperform commodities, or commodities have a stronger case here?
I think currently the way things are, I think if there is a global slowdown, then I would feel that equities should be the good asset class in India as compared to commodities, because as global growth slows down, commodity prices will cool off, and there was a little bit of overheating that has happened in that. With the caveat, and the caveat being that if there is any liquidity expansion measures in the US, like a QE3 or any other expansionary liquidity, move by the US Fed, then commodities will have a very big spike, because I think any excess liquidity will go into commodities a lot faster than emerging markets. As of now, is what appears. So I think in the absence of that, I think equities will do well. And I think in India, equities are becoming reasonably priced. And if you are indifferent to the next 3 to 6 months and you want to, if you're comfortable holding it for 3-4 years, there is going to be a lot more opportunities. So next 5-6 months, it might be a great time for an equity investor in India. Though an equity investor might be a bit early, but I think as they say, if you're an investor, you want to invest a bit early, and if you're a trader, you want to sell a bit early. I think that's the time to sell has gone away. The time to invest is starting, and in the coming 5-6 months, it might be a good time for equity markets.
Well, I like that phrase of yours. The time to sell has gone away, and the time to invest has started. Vimal, where are you advising your clients to invest?
We are advising our clients to invest, have a balanced portfolio, because India has a very peculiar characteristic of clients that there are many investors who invest in equity. They don't put any money at all in debt, particularly not the high net worth individuals, but the mass affluent. And then there are investors who invest in debt market or bank fixed deposit, and they don't put any assets in equity. So our advice is that these are actually the time when you should have a balanced portfolio. I mean, you should have a balanced portfolio in all time, but these are when there is so much of volatility and so much of uncertainty, then you should have part of your assets in equities, part of your assets in fixed income instruments, and part of your assets in gold. Gold, Indians have held more as for social purpose and not as a portfolio choice. I think this is times have now come that you should have some core portfolio in gold, and you can have it through ETF or mutual fund also now. And of course, you should have some exposure to real estate, but they're typically, a typical small investor will have it for own use, just own house or own office. So we are advising a balanced portfolio approach in these times.
Dinesh, where do you think deep value has emerged, and where do you think a margin of safety is still missing?
I think definitely deep value has emerged in small and mid cap, but it is a very difficult sector for an investor to invest directly. So for investor, I would say value has emerged in company like Reliance, who has shown a good quarterly number, who has shown a growth of around 17%. As you can see, for past 3 or 4 months, it has underperformed by around 12 to 15%. So it appears that for an investor, it will be good that he, when market has corrected so deep, there is an value emerge in lots of large cap stocks like even L&T. L&T also looks to be a good pick for long-term investors. And for an investor who would like to would not like to go for an stocks where there is a huge volatility and it is connected to interest rate sensitive. So I think for them, FMCG also looks to be a good bet. They will get a good absolute return in the sector, though valuations are rich at this point in time. But I think still looking at the way consumption story is panning out in India, it appears that investor can get an alpha return in this sector. Apart from this, I think there are lots of leaders available at a very cheap price. Like in print media, Jagran Prakashan appears to be a good value buy. In agrochemical, United Phosphorus appears to be a good value buy. And definitely our banking sector, our all-time favorite remains in that private sector, remains our very favorite. I think Axis Bank appears to be a very good value buy. If you look at a valuation gap between leaders like GFC and Axis Bank, there's a huge gap. And I think going forward, one can unlock this kind of values.
Rashesh, what is your sense on news flow from center? And do you think now finally, and thank God for this one, Government of India is taking baby steps in the right direction?
Yeah, I think it appears that there is a very implicit kind of indication from the government that enough is enough and we will now start, taking the initiative, seize the day in a sense. Though I think Indian government will not ever do it overtly. They have started to make those, and I think the key positive upside in India is, any move from the government towards reform, towards, saying enough is enough. We need to get the economy back on track. We need to get reforms back on track. And I think the key positive surprise will be that. The other positive surprise is, as if the commodity prices go down and RBI comes out after a month or month and a half and says, now we are feeling comfortable that inflation is coming back under control. Even, I think, along with government reforms, I think it will be another key, very positive surprise for the market.
Hemal, you just mentioned that you expect 4,700 or 4,800 to act as a serious base for the Nifty. Why do you think markets will not go below 4,700 or 4,800?
I think at that level, in fact, even 5,000 is a support which Nifty will take some effort to breach. But even if you have a spate of bad news, at that level you will find serious long-term investors buying. So I think India is not off the radar of large institutional investors or long-term investors. It is just that they are waiting for appropriate valuation, and you see more money coming in as valuations become attractive. So I'm personally not very bearish on the market. It may remain range bound with some bit of negative bias, but it is not a market where you expect a free and a vertical fall. So at the 4,800 level, valuations are very, very tempting.
All right, gentlemen, stay with us. A quick break on market makers. You're watching Market Makers, the special edition, correction or crash.